Hi and welcome to our Thursday Q&A marathon where we talk macro, trying to make sense of markets that, well, really don't make any sense, but more importantly, answer your questions, and that's what we're going to do today. I'm your host, Steven Van Metre, and thanks for joining me. Before we jump into your questions, there are some rules in submitting questions in case you're wondering how to do that. First, you can have to send me an email or message me on Facebook or LinkedIn. I do not take questions from the comments. Please put your first name if it's not obvious, so I can at least reply back to you instead of saying, hey, Big Dog 44, great question. It's always nice to use your name. Number two, I have to have some semblance of ability to answer your question. So if it is beyond the scope of my knowledge, I will simply let you know. And number three, I do not comment on the research of others. So if you do have a question about someone else's research, frame it in your own question. All right, let's begin. First up, been following your vids for the past few months and have learned so much in a short time. Thank you very much for the education. You're very welcome, and thank you for being part of the show. I have two questions that I'd appreciate if you can answer. Number one, can securities dealers, the ones who buy U.S. Treasuries from the auctions, buy these Treasuries on credit? I believe the answer to this question is yes. I do not know for a fact, but it does seem extremely logical because following the great financial crisis, the Fed put into place effectively a relief valve at the auction. So in case there weren't enough people to buy, the Treasury securities dealers buy everything. Whatever no one wants, they have to buy. And assuming they don't have the money, they need to get it from somewhere. So it does seem logical that there is some sort of lending facility, not say through the Fed, but through the large commercial banks to facilitate that. And under those conditions, we would also presume that the Fed would be stepping up with its quantitative easing program to buy them. So it does seem that that is correct. I don't know the answer, but maybe someone watching will and will let us know. So the flow of funds would look something like this. Borrow credit from a bank, perhaps their parent, okay? Buy Treasury at auction, okay? Sell the Treasury to a buyer / commercial bank for a slight profit. Yep, I'm with you. Pay back the credit and keep the slight profit, right, into the road for the security dealer, correct? Commercial bank sells the U.S. Treasury to the Fed for a slight profit, and the money is held to the Fed account, which they can use as collateral 9-to-1 to issue more credit, correct? Although I don't believe the Fed or the commercial banks are even borrowing against their excess reserves at the Fed. I don't believe they even need to. I think currently they're only lending roughly 1-to-1 against their deposits. But yes, theoretically, you're right. They could go on to use that as collateral to issue more credit. If that is possible, couldn't that process hypothetically be rinsed and repeated until the banks are lending out 9 times or so against their reserves? Yeah, that's correct. And so the question is maybe, and we'll get to the rest of it, is why isn't that happening? Is one, banks have to risk their capital, and two, borrowers have to risk their capital. So you have to be willing to go to the bank and say, look, I'm willing to post, say, my house as collateral against this loan or whatever it is you're borrowing for. And the banks have to be willing to risk their capital in case you default. So that's really why we don't see this or see them lending against that, but they can. So that is correct. And hence, U.S. dollar in circulation, deflationary distributed through the Treasury into the population, would be drastically increased if this is used to reach peak money creation. Yeah, absolutely. I understand this probably isn't practical, but I'm wondering if it's possible. Yes, it is. In fact, if the banks were lending out like that, there would be lots of dollars running around, lots of inflation. Number two, in March, with big bad virus scare, the Fed announced that the reserve ratios for all banking institutions were lowered to 0 from the previous 10%. From this change, the charts of excess reserves now reflect this change. It doesn't mean the 9-to-1, not exact. So the 9-to-1 is they can lend 9-to-1 against their deposits. Lending ratio is no longer intact. It is intact. So, and can the banks create unlimited credit? No. Let's go and first answer what the reserve ratio is. And well, let's look at excess reserves. So was there anything that happened in excess reserves? And the answer is no. Nothing. Does not appear there was any effective excess reserves at all. Okay, let's look at what a reserve ratio is. So we'll go to Investopedia. The reserve ratio is a the portion of reservable liabilities that commercial banks must hold onto rather than lend out to invest. This is a requirement determined by, in this case, the Federal Reserve. So the bank doesn't have to hold any money in reserves of its liabilities when it lends out. That's all that really means. So it didn't change anything. Or does the Basel III ratios precede this and effectively doesn't mean anything? No, the Fed did lower it, and I don't know how it affects Basel III, so I'm not sure on that. But from what we can tell, it didn't do anything. It seemed to be more of a psychological thing that the Fed said, hey, we're going to drop the reserve ratio, and nobody cared. In your opinion, do you think this change in the reserve requirement ratio was more of a suspension to try to stimulate the economy psychologically? Yes, I do. I agree completely with that statement. Banks still won't lend out more than 9-to-1 because they're marginally lending 1-to-1 because they know this will be reserved. No, the banks just don't. They just don't have the demand or the desire to do more lending. And do you think this will be reversed swiftly as possible when the economy is starting to improve? Yes, it probably will be. Thanks for your time. Thank you, Steve. Appreciate your time. Sincerely, Big Dog West Side. Woof, woof, woof. Oh boy. Well, let's hope the East Side big dogs don't show up or we'll have a problem. These are fascinating and useful videos. Thanks for providing this content not available elsewhere. Well, thank you for being part of the show and tuning in every day. Seems like now, doesn't. 2 questions. 1, wondering what your dad said that was so useful. If you answered that question already, sorry, but I missed it and maybe others did too. Yeah, I don't remember which video that's in, so let's answer that. I'll be very brief for those of you that heard the story. It's still a great story anyways. When my dad and mom got married, they lived in Los Angeles. And my mom decided that she would save her paychecks. That was their deal. So my dad would pay all the bills, she would save her money. So when they went to buy their first home, they had a down payment, whereas other people in their income level didn't. And so they were able to buy a house. If you ask my dad, he would pretty much tell you he wasn't sure how he was going to make the payment. And to do that, he worked second shift, overnight shift, overtime. Pretty much any time he could work, he worked. And so they bought this house they couldn't afford in Glendale under normal conditions, but they got in there and they made it work. And then the housing market in Los Angeles, boom, took off a few years later. And they were sitting on a massive amount of equity. Now, if you have equity in your home, it really doesn't do anything other than, it's nice to brag about it. So a financial advisor gave him some great advice, and he ended up getting transferred. He worked for IBM at the time, and he ended up getting transferred up to Bakersfield. So he sold his house and pulled all this equity. Now, normally you might think he put it all down on the house. No, he actually didn't. He went to one of the nicest neighborhoods in town, built a custom home. Wasn't by any means the fanciest home in the neighborhood, but it was a very nice home on a large lot. And he got the biggest mortgage that he could at the time, which was a 14% variable rate loan. Now, if you're like, well, why would he be so dumb as to get a variable rate loan? Don't worry. I asked him that question several times, actually. And he said that, Steve, that's because the banks weren't offering fixed rate loans. Do you think I wouldn't have gotten one? And I would have, because it went to 16% the next year. But here's what he did. When you have a large mortgage, a wife that's not working, and 2 kids, you have a lot of write-offs. Is federal and state income tax bills? Boom, 0. Now he still had to make this mortgage payment. So what he did, the advice he was given by this financial advisor, was go out and buy tax-free California munis. So he took all of his equity and bought California tax-free munis, which were paying 12% of the time. That's called tax-free for a reason. So he used the income off the tax-free munis to make his house payment, and he paid effectively 0 taxes. Now, as a kid, I remember every so many years we'd go and do this refi thing. And when you're a kid, that's one of the most boring things you could do because you had to go to somebody's office. And I don't know why I remember it. I just do. And my dad refied down every time rates dropped 2%. And because of that, in a neighborhood where we as a household were probably on the lower end of the income spectrum. I mean, it's a very nice neighborhood. It still is to this day. And so my mom didn't work, whereas most people had 2 income families, or the primary worker earned a sizable income. We didn't have the fancy foreign cars, the fancy clothes, the fancy toys. the European vacations, but we had a very nice upbringing in a very safe neighborhood with some of the best schools in town. And had that not happened, who knows where our lives would have been. But because of that advice, you think about this from a macro perspective. What did it take? It took my mom saving every penny of her paycheck and waiting for the opportunity. And then the opportunity came and they did it. And then the next opportunity came and they followed it. I mean, I'm sure that was a massive leap of faith for them at the time. I could only imagine, but they did it. And then it took a lot of courage to go out and buy these tax-free munis, drive the tax rate down, and follow the plan. But that was a macro event in my family's life that completely changed the course of our family's history. There's no telling where we would be had that not happened. And of course, from there, my dad learned more about how to do these cool things and, learned to save and plan and execute, and taught that to his children. And I've done some cool things, and, macros can be life-changing. Number 2, interest rates fell after the great financial crisis and the equity market exploded. 10-year equity bull market was a stock market out of sync with interest rates for 10 years. Is that dislocation continued today? Gracias. All right, let's take a look at the chart. So let's go back to the bottom of the great financial crisis. The S&P 500 is in purple. 10-year treasuries are in the bar chart with the green and red. And so you see yields bottom and then stocks bottom about 3 months later. And then the two were connected, they went and moved down and they moved up together. And it wasn't until if we kind of split the difference, roughly right here in August of 2011, interest rates head back down and stock prices go up. And why is it normal that you see after a recession ends, interest rates still haven't finished bottoming? Is because the consumer is still healing from all the damage. And in this case, it took, about 3 years for the consumer finally to get to a point where they could start borrowing, and then all of a sudden interest rates headed higher. So this dislocation was fairly temporary, and then it kind of reconnected later on. And so today, in the shorter term, we have to go to the weekly charts to see this. But yes, we're in a dislocation for sure. There, and you can kind of see they've kind of moved together in the short run, but there is a massive dislocation in the bond market. Maybe we can zoom it in a little bit more. Maybe if we can try a 2-year chart. Yeah, you can see they kind of came down together, and now they're definitely dislocated. Not so much like they were maybe in 2011, but there's still a fairly large dislocation here. All right, let me clear that off because I know we have a couple more chart questions coming. Okay, these are fascinating and useful videos. Thanks for providing this content not available elsewhere. You're very welcome. 2 questions. Wondering, oh wait, does a potential spike in US dollar currency swap, see, I told you don't edit. Does a potential spike in US dollar currency swap need scare you at all, being bullish on US treasuries? No, it does not. Let me get that chart for you. Hang tight. Browser. Switch. Okay. So here are monetary authority, non-official foreign currency swap lines. We only really see these going into recessions. And so here, the great financial crisis, you see swap lines went up, yields were flattish. And then swap lines went down. Why? Because the Fed eventually had to step in and massively do quantitative easing, and that drove interest rates down. So here we see swap lines rising and yields actually fell. And it's possible these swap lines are just keeping yields fairly flattish here, but no, being treasury bull does not impact my view at all. Arguably, it's supporting my view because it says the world dollar liquidity problem is not solved and the Fed's going to have to do a lot more QE. If not, hopefully you can explain to me how, saying to me why, so that I can also be eased out of the worry I have over this as well. Thanks and love your show. So the idea is, what is the problem is there's a shortage of dollars, and the only way it's going to come back is if the U.S. consumer goes out and borrows, spends money in the foreign economy, and obviously that's not happening. or at least not significantly enough that we can see in the data. So ultimately, the end-game solution is the Fed is going to have to drive interest rates down. Now, they've already got the Fed funds rate effectively at 0. A lot of rumors, will they go negative? I just don't see that they're going to need to yet. I think they have a lot more to go. So what do you do to get interest rates down? The only other tool they have is quantitative easing. We know they have to drive rates down because, one, world liquidity isn't being restored. Number two, we can look at the weekly lending data and see that interest rates are still too high. It's not creating lending demand and lending growth. So again, yields go lower, bond prices go higher. So hopefully that eases your mind a little bit. Glad you could be part of the show. Appreciate your question. All right, next. Oh, and I just watched your Monday 6/15/20 show, and in the beginning you showed how foreign investors drop long-term treasuries and actually increase their holdings of short-term treasuries, and you were pondering why that may have occurred. I was. From what I read, it seems that this is the market's anticipation of implementing yield curve control on 3 to 7 year-ish more intermediate term U.S. treasuries. They figured that this would be the next Fed response when the next market panic occurs. So they're all trying to front run the bet ahead of the Fed announcing it. And this is why I don't read other people's stuff, because I completely disagree. And I will show you why. Because when in doubt, go to the charts. So let's go to the charts. Treasury yields, 13-week Treasury yields. It looks like the Fed's got a handle on this. There really is no massive increase in yields going on here at all. So Fed, we would say, total control over the short-term yield curve. How about 5 years? Well, nothing going on here. A total of flat. So yeah, no loss of control over 5-year bonds. How about 10-year? Well, they've gone up slightly. They've gone up about 0.2%. Now, some people go, but the yield's up 40%. Okay, yeah, it went from what, 0.57 to 0.75-ish, somewhere in there. Yes, that a 0.2 of that is a large move. In the grand scheme of things, in Treasury yields, 0.2%, nothing on the 10-year. So for the most part, does the Fed got control of the 10-year? Yes. How about the 30-year? Okay, it's gone up, but why has the 30-year gone up some? Because everybody's shorting this thing because they think inflation is coming, but it's not. But they're shorting the long bond looking for the big payoff if inflation comes. So if there was any one space the Fed is struggling with, it's the long bond. And so the notion that we even need yield curve control, I don't think so, because the Fed's pretty much got control of everything, and they still can do a lot more QE. So we have to think of why would, say, Bank of Japan do yield curve control. I have trouble saying that. Say it 3 times real quick, see if you can do it. I can't even say it once. So why would the Bank of Japan need to do it? Because they bought all of their own debt. I mean, it's like, look, they bought everything. The Fed still has, over $15 trillion worth of U.S. Treasury debt they theoretically could buy if they bought all of it. They've got a lot they could do here. So I don't see I don't see anything in here that says the Fed's losing control of the yield curve, why they would need to do curve control. I think they're just going to do more quantitative easing. In fact, I would bet they would. And if they don't, then effectively yield curve control is just a QE with a stated price target, which technically you'd think quantitative easing already was that. But no, I don't think we see yield curve control, and I don't think that's why. I have no idea why. Maybe someday the answer will make itself known. Hi, Steve. Love the show and continue to learn every episode. Awesome. So do I. I have been hearing a good bit about asset inflation. Is there any way the data continues to show deflation and asset inflation persists? So here's the deal. There's only inflation in 2 places, asset-wise. Stocks and real estate. That's it. Everything else, we're seeing massive amounts of continuing deflation. So those are the only 2, and those 2 will have their day. They do eventually come down. Next question. Also, how does a company like Amazon perform during deflation? Let's rewrite this to say, how does a retailer perform during deflation? I'm not asking about the stock performance for any trading advice. I would just like to hear your thoughts on how retailer or the retail business model and what deflation means for it. That is a great question. So what is deflation? Deflation is when there is less money, shrinking. And so when there's less money, what happens to people's pay effectively? It goes down. Now you say, well, I'm on salary. Okay, well, maybe you don't get a bonus, you don't get overtime, but a lot of people, it means their pay goes down. Hours are cut. It does not specifically mean wages are cut. Could be jobs are lost, layoffs, furloughs, whatnot, but wages overall go down. Now, when a consumer has less income and they have a lot of debt, which is currently the status of our economy now, the debt doesn't deflate with the income. So that means a consumer has less what kind of income? Discretionary. So when you have less discretionary income, what does that mean for a retailer? Well, it means you're going to have people spending less money, and that means from a retail perspective, lower earnings, lower profits, and should be lower stock prices. Although in this market, nothing seems to matter. Hi, Steve. Your show taught me more macro than my Macro 101 course in school. Sweet. Thank you. You're welcome. I now have a better understanding of the relationship between treasury yields, stocks, and etc. I have not quite figured out the relation between the dollar index and yields. My educated guess is that if yields decrease, foreign investors would sell treasuries and collect dollars, which increases foreign dollar supply. So if yields, so bond prices, so let's clear this up. If bond prices rise, foreign investors would sell treasuries and collect dollars. So you mean they're going to buy low and sell high. Okay, that kind of makes sense. The confusing part is whether the increase in dollar makes the dollar strengthen or weaken. Well, a rising dollar does make the dollar strengthen. Would you be able to correct where I'm wrong and enlighten me? Thanks. You bet. Let's see if this enlightens you or not. If not, let me know. We'll take a stab at. So here is the trade-weighted dollar and 10-year treasury yields. So when the dollar rises in blue, it puts downward pressure on treasury yields, or it acts as a suppressant. So here the dollar's rising, yields went down and then held. Dollar's rising, yields went flat, and then the dollar fell, but yields were held flat here. Dollar is rising, yields are headed down. Generally, not always, but generally, as the dollar rises, yields go down, and there is your relationship. You know, when we're in a period of dollar shortage, as we are in the global economy, there is a demand for dollars. So dollars go up because people are going to sell things and want dollars, and that does push downward pressure on treasury yields. So hopefully that answers your question. If I didn't, please resubmit something and we'll give it another go. First of all, great videos and thanks. Oh, great videos and the way you explain complex macroeconomics is unmatchable. Ooh, that's cool. Thank you. Unmatchable. I have two questions for you. One, with the recent announcements from the Fed related to buying corporate bonds, direct bonds, not ETFs such as J and K. Right. Okay. So they announced that 3 months ago and no one paid attention, but they realize they're going to start doing it now. Isn't this an indirect way to give cheap money as interest rates are low to corporations, which they typically use for share buybacks? All right. So let's clear that up. They're not using this money to buy their stock. They were, but this is not. So they're not the companies are not issuing debt right now to buy their stock back. Why are they issuing debt right now? Because they're trying to pay back what are called their revolvers, or their short-term equity lines. So I used this example, I think, on Monday. I have a financial emergency. I need to pay the bill immediately. I swipe my credit card. We'll just say it's 30% interest. I can't afford to immediately pay that off. So I'm still dealing with the problem, even though the bill has temporarily been paid. The credit card bill comes in, I write the minimum payment. In the meantime, as my crisis starts to clear, what am I going to do? I can either pay down this credit card bill, or I can try to refinance that into a fixed rate loan, maybe an equity line, maybe refi my house, get the payment down. And that's exactly what we're seeing corporations do right now. They pulled their revolvers, their credit lines. We'll assume they have a fairly high interest rate relative to the bond market, and now they're going out and issuing bonds. The problem is the bond market can't stomach all of this. That's just what, you got to think of, is the Fed really trying to push the market up, or are they trying to protect their children, the large commercial banks? They're trying to help their kids. And so all this debt's being issued. And I don't think the bond market can handle all of it. And so the Fed's just trying to take some pressure off. That's what I think is happening. I have some deeper thoughts on this that I want to save for a future video, but that's kind of what I think is going on. I do not believe that money is going into share buybacks at all. Mostly a U.S. phenomenon and not much of a European market phenomenon. True, that's correct. Possibly, can you explain the huge divergence between the two markets? Oh, probably can explain the huge divergence between two markets. Yes, it probably can. Number 2, how do you manage FOMO, fear of missing out, while your macroeconomic hypothesis play out? Thank you, and as always, truly appreciate the stuff you put in your videos. Very informative. You're very welcome. It's simple. Ask my wife how any of the Back to the Future movies ends. She knows. She's watched them a bunch of times. A bunch. She knows. So if you know how the movie ends, then you watch it. And you kick back and focus on the details. For example, one of my favorite shows is Star Trek Deep Space Nine. Now, a lot of people think, oh man, you like Deep Space Nine. It's like an awesome show. And the first time you watch it because you're a big Star Trek fan, right? The second and third time you watch it, which I have, you can start appreciating deeper aspects of the plot and the characters, because the acting in the show is quite good. And you can really get into the nuances of the actors, the sets, and things, and how they work together, the plot. Fantastic. That's macro, right? I know how this ends because we did all of this during the Great Financial Crisis. And all Powell is doing is effectively copying the Bernanke playbook, which, he's running it at bigger numbers, but he's effectively copying it. But who did he mentor under? Bernanke. He was on the board when Bernanke was in charge. So he knows what to do. So we know how this is going to play out because we know world dollar liquidity has been destroyed by the Fed tightening monetary policy. How do you fix it? Well, the Fed doesn't have the tools. They can't. They cannot fix it. So the only thing is interest rates have to go down low enough to get consumers to borrow and spend. And when that happens, it drives stock prices down. Look, I know how it goes. So how do I deal with FOMO? I know how the movie ends. I know exactly how the movie ends, and the data is, and every day the data for the most part with a couple of little outline pieces here and there is telling me I'm spot on. And I trust me, I go through the data every day, and Chris Stark and I, we talk almost every day about, are we right on this thesis, because we agree on the same thing. And so we're trying to constantly look at the data. He's looking for what I'm missing. I'm looking for what he's missing. We come together, meeting of minds, and we try to say, are we wrong? And the answer is no, we know how the movie ends. So thank you for doing these videos. You're welcome. Question number 1. When the Fed tried to tighten the QE program back in 2018, the stock market tanked. This tells me that the Fed had a direct influence on the stock market because it recovered after they eased. Can you explain why you think this time QE not going to work since it worked back in 2018? All right, so that is a good question. Why did the stock market tank in 2018? Let's see. 2020, nope, go back further. 2018, right here. Why? Because the Fed tightened interest rates. Interest rates were too high. So this is what some people understand, is interest rates were too high. And it was constricting credit creation. And we're in a debt-based economy. In a debt-based economy, see, I look at it like a sphere or the globe or the earth, right? And as the economy expands, the reason I do this is because the debt has to go with it. It has to expand. So when interest rates go too high, right? In an economy based on debt, what happens when there isn't enough economic growth to back higher interest rates? Well, the economy goes down, and then interest rates start to go down, and then stock prices follow because the economy goes down. Now, why did the market rebound after 2018? One, corporations were still doing share buybacks, so that helped. And number 2, there's a psychological effect of QE. It wasn't an economic growth story at all. It was just the fact that people believed that the Fed could ease stock prices lower. And it doesn't work that way. So let's come back and make sure I've got your question. Whoops. Here we go. because QE doesn't work that way. I mean, you can also look at the credit data, which we look at every Friday, and say, look, are interest rates low enough? Whoops, did not mean to do that. Low enough to spur lending demand? And no, we're seeing the opposite. Lending growth is slowing or contracting in certain areas. And that tells you that interest rates are not low enough. And so if interest rates have to go lower, so do stock prices. And that's because there's a relationship between stock prices and yields. Lost the question. Here we go. Number 2. So hopefully that answered your question. QE does not, and it doesn't work that fast either. It's not. There's lots of lags in monetary policy, just in about 2 years. Question number 2: with the stock market almost fully recovered, have you adjusted your timeline to retest the March lows? Yeah, a little bit. I think I'm out maybe an extra month or so. Yeah, I'm out a little bit, but I don't think it retests it. I think it goes through it. Fun to make predictions, huh? We'll see if I'm right or wrong. But there's no doubt in my mind we'll at least have a retest. If we have a retest, okay, that to me is bullish for stocks. If not, we go lower. Quick follow-up. The retail data came in much higher. Larry was right. He was, because he probably actually saw the data ahead of time. Any thoughts on why he was right and I was wrong? Well, I misunderstood what he said. I covered this in the Wednesday 16th video, so go back and check that out. If you still have questions, send it back in and we'll talk about that. Why was he right? $600 a week. I mean, look, the Fed pumped $3 trillion into the economy. That's half of the annual retail sales. So retail sales a year are $6 trillion. So we got a boost because people thought it was okay to spend. I don't buy that that's going to last. But anyways, check out the Wednesday video. Hi, Steve. I discovered your channel back in February and March and have not missed an episode since. Wow, that is so cool. Thanks for the incredible work that you do. I refer to your work to many of my friends as the best kept secret. Well, that's pretty sweet. Thank you. I really appreciate that. While I completely agree with your macro assessment and understand the reasoning behind your assessments, I cannot help but wonder. One could argue that it's a matter of national security, and I know whose research is referring to, but that's okay because I said just take their name out. Competition with China, that the U.S. equity markets remain at all-time highs to produce a growing GDP. That is the only way the incredible amount of debt can be sustained. Would you agree with this? 100%. Why does the stock market matter? Because there is extremely high relationship. I wanted to say correlation, but my wife would probably tell me not to say that. The extremely high relationship that when stock prices rise, people spend. Hey, what do you know? When you feel richer, you go spend. Shocking. This was learned a long time ago, by the way. So yes, so you want to get the stock price, keep stock prices up to keep people spending. What is the problem with that? 90% of the stock market is owned by what percentage of the U.S. population? 50%. So half the people don't participate. So the wealth effect for half Americans? Not there. That's the problem. But believe me, they do want the market to go up. I don't know specifically if President Trump knows the data, but if he didn't know it when he came into office, I've no doubt the people he brought in do. Stock prices lead to spending, but QE leads to lower stock prices. Go figure. If so, the Fed and the U.S. Treasury will do everything in their power. All right, well, let's draw a line through U.S. Treasury because U.S. Treasury has no power to do anything here to keep the stock markets high. Correct. So the Fed is going to do the only thing they can do, jawbone and more QE, because people believe that QE leads to higher stock prices, even though it doesn't. Producing the biggest bubble in history. Yes, that's what they're going to do. That being said, how much of the macro thesis still makes sense then? Every bit of it. Because look, central banks may be able to blow bubbles, but they can't sustain them. There's no record in history of any central bank sustaining a bubble perpetually. If it did, our lives would be totally different because we'd be living in a huge, gigantic bubble beyond anything anyone could believe. All right, let's see. That being said, okay, if it seems like the markets just don't make any sense, as your opening line goes, but if they never will again, they will. Check the Wednesday video where we go over world all liquidity. The global economy is contracting, and there's only one solution, that is to crash asset prices. What if we are experiencing a fiat currency crisis and fiscal spending / debt issue that cannot be resolved if not for significant inflation? That's kind of the going thought. If in this case, equities could develop like Venezuelan or Argentine markets. Would be curious to get your thoughts on this. Look, stock prices go up under moderate inflation. They do not perform very well on high or hyperinflation. The data over history shows it. Now, do they go up during high inflation? Yeah, but you're better off owning a lot of other things. Go back to the read stuff about the Weimar Republic in Germany. People did make money in stocks after a while, but even corporations get hit under high inflation. Who made all the money? Those who owned real property, because they could pay off the loans on the real property with inflated money, and the property values went up. Things like precious metals, real estate, that did well, but stock prices do not do well under high or hyperinflation. Yes, they look like they're going up a lot, and they are, but relative to everything else, not so much. What are your thoughts on the change from the current deflationary situation to an inflationary one? What are you looking for as signals? How will equities, bonds, and gold perform? I'm looking for a bottom in the treasury market and a V off the bottom there. How will equities perform? I think stocks go up, treasury bonds go down, and gold or precious metals go up. Thanks for all you do. Keep up the great work. I will, and keep watching. Hey, Mr. Van Metre, I've got a question for your show. You're free to call me Steve. My dad can be Mr. Van Metre. So you've been saying that deflation is coming, but when I look at the inflation graph, referring to the consumer price index, we're still above 0 at 0.1 as of right now. So do you think we're going down deeper? Because that would be a huge problem. Yeah, I do. I think we are going to see what we saw in the great financial crisis, where we have a massive crash in the consumer price index. So yes, and it would be a problem for all. You are right, except for, well, no, it would be a huge problem, but not for all. Great thing for savers, bad for people in debt. Hello, very interesting videos. Yours are. Thank you. Question, do you think we can have a collapse of pension funds if zero rates go on for much longer? Look, I think pension funds nationally are in terrible shape to begin with. I mean, California is not in good shape. Retired people left with nothing or reduced pensions. Look, that's really the simple solution is, let's say that your pension's 70% funded. How do you fix it? Drop everyone, those on it and those to be on it down to 70%, and you're magically 100% funded. I mean, it's kind of what Social Security is going to do in about 2033 or so. Everyone goes down unless there's reform. So let's see, going on. How can rates be raised again with so much debt? That is a good question. How can they do it? We don't have the answer. What is the debt exit plan, and how will this possibly play out? There are at least two known potential outcomes. Inflation, well, three. Inflation, austerity, or war. And war kind of gives you a little bit of both. It forces consumers into austerity but creates inflation. War is a very common tool for getting out of these type of situations. Go look at war cycles and recessions. You'll see that it's not unusual that a world war helps get economies going again. Couldn't central banks keep small short waves of buying bonds, so treasury bonds, cheap, and selling the bonds to the Fed higher? So effectively what the question is, could we get an oscillated pattern, where the commercial banks are pushing bond prices down to buy and then selling them back to the Fed and then bringing them down and kind of going on kind of like a jigsaw pattern? Theoretically, yes, but however, no, because the Fed, and what I can tell, is buying about 5 billion more bonds per month than the commercial banks have supply. That drives bond prices higher and interest rates lower. So no, resulting in no spike to lower yields? No, I don't think so. I don't think it plays out that way. And besides, we're seeing no demand from consumers. I mean, at some point, yields also will fall due to the lack of demand, credit demand. Steven, great video today. Please tell us your VIX story. My broker actually blocks me from trading volatility indexes. You should thank them for that. So I suppose I'll learn why from your story. Thanks. And this will be our last question. So, I don't know when I'm going to tell the VIX story. I don't. I'm not comfortable telling it yet. And I'm not comfortable because of the outcome. The outcome is sensational. I mean, it's like a movie that is just getting worse and worse, and you're like, oh my gosh, like the main character is just like, it's so bad. Like, and then all of a sudden it's like, how did this ending happen? When I tell a story, or if I tell a story, I mean, I probably will someday, but I will tell you what concerns me is it will change this channel. And it may not. I mean, I'm concerned that things will change, and I'm not saying that it will be for the worse. I don't know. It may be for the better. I don't know. I'm just, part of me says I'm not ready to tell the story yet. And it's like I tell you, it's a fantastic story about intense macro research, just brute risk tolerance. I mean, just absolute, screaming pain, risk tolerance, but still persistent with the data, persistent with the research, persistent with the philosophy, holding for the long term when all else says you shouldn't do it and you're stupid. And then this just incredible ending. I mean, it's just like, wow. And it's all about something no one should ever touch. And even as a professional, people have told me I shouldn't have touched it, but I did. And I did my research, and I will never touch it again. But I just don't feel like I'm ready to tell the story yet. I don't know what will change. I'm enjoying the channel. I'm enjoying all of you. And I don't know, maybe it'll change your view of me. Maybe it'll be a positive change. Maybe more people will want to watch the show because you can do cool things with macro. I don't know. I just don't know. And so what I do know is I'm not quite ready to tell the story. Part of me is committed that I will tell it someday. Maybe we'll mark it as an event. Maybe if there's a certain number of subscribers, or maybe if there's when I'm right about interest rates hit bottoming out. I don't know. I don't know. I do want to share it with you. I just don't know when I'll be ready. Is that fair? Can we work with that? And thank you. Thank you for your patience. Like I said, it's a very small number of people actually know the story, and it's pretty cool. I mean, it's life-changing. Even though my wife and I have not done anything different in our life since this happened, it is changing our lives somehow. I mean, it does. I mean, it changes things a lot. So when I'm ready, I'll tell the story, and hopefully good things will come out of it. But we'll see. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This trail is not to be construed as a recommendation or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed in this video that I'm on do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.